Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, October 7th. With the Moose, John Mousseau, CEO, President, Director of Fixed Income. Another volatile week. Started off with a really nice couple of breath thrusts in the equity market. Had dominant advancing versus declining issues. When you see back-to-back days, that can bode positives.
Good start to the week, for
longer
sure.
term. Disappointing to give so much of it back. S&P finishes up, call it 1.5% for the week, off of being up 5.5, 6 post Tuesday. So still flirting in most sectors and industries with those June lows. You know, we get down there, there's been some demand. Ideally, you would have liked to see this lift early in the week, at least back and fill and hang around those levels. So head into the weekend with some disappointing price action. John will get into, what was perhaps the catalyst for it today. In terms of what's working, not too much. Energy stocks. Energy stocks had a solid week. We have a position in energy stocks, not large enough. We'll get larger there. Similar to May, June, when the energy stocks were the only thing working. Right. Because this sector is not very large, they tend to get crowded, and you can get
crowded fast.
You can get some very steep drawdowns. XLE dropped 15% in 5 trading days. Right. So we have to be a little bit careful there, especially when it's the only sector working. Right. Because money piles in. In terms of other areas that are working, not too much. Healthcare hangs in there. Defense hangs in there from a relative standpoint. So we'll concentrate on looking for some opportunities there.
Great.
What about fixed income?
A mixed week, Matt. When you look at today, which we had non-farm payrolls today, a little stronger than expected, but not much. And the revised private payrolls down a little bit. Wage growth flat at 5%. It's a high number, but it didn't grow. So you can read some positives out of this, negatives out of this. The net of it, probably Fed's going to still be on course to raise short-term interest rates. That narrative doesn't change. What's interesting to look at is you look at the 10-year Treasury bond, closed at 388, pretty much up 10 basis points for the week. What's more interesting is that even with this number today, which faded the Treasury bond a little bit, last week you had touched 4% for a while, right? Went back down, still haven't gotten back there yet. So the narrative hasn't changed. The Fed's still out there, will probably raise rates. On the flip side, some good news. On munis, last week we talked a little bit about how they hit 5%. This week a couple of deals priced at 5 quickly went under 5. So you had
showing that as soon as clients, as soon as institutions saw that 5, the demand was through the roof.
Absolutely.
How much were they oversubscribed, those deals?
17 times. I mean, a lot. And I think what's interesting about this is that this was a week where Treasury yields were up modestly 10 basis points. But muni yields were down about 10 basis points. And listen, this is a beat-up asset class, right, as we've continued to talk about. But there is a little bit of light at the end of the tunnel because the demand has been strong. Supply has been, down, and that's pretty much common sense. If you're a municipal issuer and rates have gone up like they have this year, if you can have any flexibility to not issue bonds for a while, you're deploying that and holding back. So supply is down. We think demand goes higher as you reach towards year end. That's traditional. So we're constructive on munis for sure. And as we say, the market in general for bonds is Fed dependent, but there's no question the backdrop is still a slowing economy. Whether it's slow enough for the Fed is the open question. We'll find out more next week when we have inflation numbers.
Right. Funny stat that comes to mind when you're just talking about bonds, obviously equities and bonds in a rough patch together. There's only been 3 other years since 1930 where through 3/4 of the year, the 60-40 equity fixed income allocation was down close to 20%.
Yeah, it is.
Now,
no place to hide.
Now the positive is the following quarters were very strong. Now, does that mean you snap your fingers and things start to work out? No. But in terms of some of that damage done, as you mentioned, some of these yields, when you look at a 5% yield, that's tremendous value, especially when, if you can say if and when, but when inflation gets under control and rates start falling. If you're sitting at a 5 and a 450 and a 470 type of tax-free yield,
right, with taxable equivalents of close to 8,
yeah,
that is a compelling story. And a lot of this equities like bonds, reversion of the mean. We had the big low in yields, COVID-driven, monetary, supply driven, and you have the flip side of it this year. And the answer, as usual, somewhere in the middle. So when you have these distortions, you want to try to own some of those distortions and have to live through some of the noise till you.
Yeah,
you get to
and
the
I
promised
think
land.
we're getting close to putting some of the cash to work that we have on the equity
Right.
side. There'll be some reasonable entries.
Right.
John and I reviewed Cumberland strategies for Q3, and those are posted on YouTube as well. Please visit, take a look. If there's any questions, anything that comes up in terms of market activity, market action, reach out. All right, Moose, we'll be back at it next week.
Yeah. We hope everybody enjoys the baseball playoffs, which are just starting today.
Yep. Don't forget to like, comment, and subscribe so that you can get any of our notifications. And in terms of the weekend, relax, enjoy yourself, get some rest after a tough week.